A very good afternoon and welcome to HYCM's online trading workshop with myself, Giles Coughlin. Now, I'm the Chief Currency Analyst here at HYCM, and I'm looking forward to taking us through the dominant currency sentiment for the day. And we're also going to be looking at some key market moving events that are coming up and just getting ourselves generally prepared for what's going on. Don't forget, as I go through the webinar, that you can ask questions, and if you put them in the question panel, I get to them at the end of the webinar. A little reminder is, just going to give folks a moment to come in, and as we're coming in, just making it clear that as we're going through different entries, exits, different types of entries, this whole idea of this webinar is not trading advice. The whole idea of this webinar is that it's educational and prepares people for what's happening in the markets, so they can look over my shoulder, someone with a professional trading background, and you can see how I go about making trading decisions to help you guys make even better trading decisions for yourself. But it's not a signal trading service. And there's important reasons for that, because obviously market conditions change all the time, and that's constantly what I'm doing in my role as an analyst. I'm constantly analysing the present market conditions. One of the things we'll be looking at, a special topic we'll be looking at today, is the role of Australia and how Australia's trade impacts FX, the FX world. So we will be looking at that, and in fact I'm going to start off the webinar doing that. Most people now have come into the webinar, so I'm going to start by looking at Australia's trade. Now, Australia's trade is weighted in favour, highly in favour of China. You can see that China is Australia's chief trading partner, and it is so by a long way. In fact, Australia's GDP, the total GDP, about 30% of Australia's GDP comes specifically from trade with China. So, as you can imagine, the relationship between Australia and China is very, very important. And also, you'll see now that when there's some very good data points out of China, you may have already noticed that the Australian dollar tends to grow. Now, there's a number of reasons for that. The first reason is that China, the Chinese yuan, the Australian dollar is often traded as a proxy for the Chinese yuan. So good Chinese news will result in a boost of the economy for Australia. So the Australian dollar tends to gain value in that scenario. So that's the first reason. The second reason is that if China's doing well, that's a positive for global growth generally. And the Australian dollar, it's a commodity currency. In other words, a lot of Australia's income comes from its export of raw materials like iron ore, for instance. It's a huge exporter of iron ore, which is obviously key for growth and construction. So this is why Australia has this very, very close relationship with not only the Chinese economy, but the world economy as a whole, as China produces for the world. So that's also why any trade conflict between Australia and China is a big concern for the Australian dollar. So now going forward, you will be able to recognize that when you see data points out for China, let's just have a little look here. When you see data points coming out for China, manufacturing PMI, you can see that the data out recently was 53.1 was expected. It came out at 53. That's pretty on target, and you can see that that is a positive data point essentially, and that will be positive for the Australian dollar. So start looking now, as you're looking at the charts, start looking at when you see exceptional data for China, have a look and see how the Australian dollar has responded. This is also helpful because if you notice when the Australian Prime Minister Scott Morrison, you notice when he said that he wanted an independent inquiry into the origin of coronavirus, China took great upset with that, and they started putting tariffs on a number of Australia's products. Now, the move by China was not designed to badly hurt the Australian economy at all. The move by China was designed to remind Australia that, look, you're heavily dependent on our economy, and if you want to start causing trouble for China, if this is the Chinese point of view, then we can cause trouble for you, because obviously 30% of Australia's GDP comes from its trade with China. So that was more a symbolic act in many ways from China saying, look, don't pursue this narrative that China is to blame for the spread of the coronavirus. So trade relationships with Australia and China are very important. So you now know if all of a sudden you suddenly saw China said something, you know, we're not going to, if they said something like we're no longer accepting imports from Australia's iron ore, or you know, they expand their trade dispute, and that would be very negative for the Australian dollar and very negative for risk. So this is, I hope this is a helpful chart. I hope this shows you guys very carefully what that relationship is between Australia and, oh, right, okay, someone's struggling. ASAN is muted by organizer. Okay. ASAN, I've unmuted you, but that means you can speak on the webinar. So it's best if you ask your questions, ASAN, in the actual terminal. So you should still be able to hear, ASAN. You should, I'm just going to type, ASAN's having some trouble. You should be able to hear, ASAN. Perhaps you are, okay, hopefully I can, I've unmuted ASAN, but I don't think that's what he needs. So apologies if you've just joined us. ASAN's having some trouble and I'm trying to help him get back onto the session. Okay, but this is the big picture here between Australia and China. That relationship to Australia and China is very strong. The key thing to remember, if you take nothing else from this, remember that the Australian dollar is traded as a proxy for the Chinese yuan. What's good for China is good for the Australian dollar. What's bad for China is bad for the Australian dollar. It's all because of their very close trading relationship. So now you can see that far and away, China's is the biggest trading partner with Australia. And then the next trading partners is Japan and United States. But the big one is China. So now when you're trading FX, you can see why the Australian dollar moves around so much on Chinese data. So I hope that's helpful. Okay. Screen stuck. Okay. There we go. Hashik, thank you very much. Right. Okay, this chart here shows the trade between Australia and China. Okay, so you can see that China on the right-hand side of this screen, China is the biggest trading partner with Australia of all the other nations. So you can see that in terms of Australia's GDP, 30% of Australia's GDP comes directly from trade with China. Okay, so I hope that helps. Hashik, thank you very much, Hashik, for letting me know that. So that's the first learning point for us. A key one to have in your arsenal. Make sure you know this. because you will need it when you're trading. It's useful all the time, particularly any Chinese data. Look for a reaction in the Australian dollar. Now, going through to the session that we have, I'm just going to go back to the main screen for a second. And you guys know that, for those of you who've been following for a long time, whenever we're trading, we're always looking to back a strong currency against a weak currency. Just like we want a strong arm against a weak arm, when we're trading, we want to have a strong currency against a weak currency. That is how we make our best trading decisions when we have a divergence between two currency pairs. So going back to the screens, the key pair that we're looking at the moment today is the euro-pound pair. Now, let me explain why. The euro-pound has a bias to the downside. First of all, we have euro weakness. Recently, the ECB said at their last rate meeting, they said that they weren't necessarily overly concerned about euro strength, and they made projection that the European inflation would grow, that inflation would return to normal for the Eurozone, and that it would increase. However, recently ECB members have been talking about the concerns about the strength of the euro. They don't like it. The reason ECB members don't like the strength of the euro, and I'm thinking particularly now here of the euro-US dollar, they don't like a strong euro because a strong euro makes it very difficult for Europe's export economy. If the euro is strong, that's difficult for exporters. So a number of ECB members don't like that. Also, the recent German CPI data showed a bit of a miss. On the 29th of September yesterday, we had German CPI data, and you can see that the data came out a little bit of a disappointment. CPI inflation data expected at minus 0.1%, came in at minus 0.2%, and came in at minus 0.2% for year on year. Okay, so, and you can see here that the month-on-month preliminary data as well was a lot weaker. Germany is the largest trading member of the European Union. So this means that German data has a disproportionate impact on the euro because it's the largest trading member of the Eurozone. So that's why traders always look very carefully at the German data. So German data came out, yes, look, the inflation levels were a disappointment and far below the expected data points. This is a negative for the euro. Also, heading into the end of the week, on the 2nd of October, we have inflation data that's expected to come in at minus 0.2%. So inflation data is expected to be weak. Now we know that the European Central Bank were projecting a rise in inflation. So with inflation stagnant and deflationary conditions expected for the end of the week, on the Friday, you can see that the anticipation is for more euro selling. We also have the November US elections, and if there's more volatility in the elections, that would favor US dollar strength, and that would be more euro US dollar downside, and that would also drag the euro pound. We also had some comments from Germany about the recovery fund. A lot of the strength in the euro over the recent few weeks have been on the confidence that the market has had in a European recovery fund and the pandemic PEP program that was set to boost the Eurozone. Now, Germany were out yesterday saying they've got some concerns. And the concerns they've got is that there's more and more barriers emerging to a deal. So all of this leads to weakness in the euro. Now, the pound has some reasons for strength at the moment. The reasons for the strength of the pound is there's general optimism that a Brexit deal is moving towards a deal. The UK yesterday, they submitted 5 draft legal texts to the EU, and the general mood is still that a deal is more likely to be done than not be done. Now, there's a couple of risks here. The first risk is that if there's a negative Brexit headline, that could boost the euro against the pound. If all of a sudden the deal doesn't look likely, or there's a big breakdown in talks, that would instantly result in euro pound upside and would negate this outlook. There's also a risk that if there's a strong equity recovery, if all of a sudden we see equity markets really boosting higher, that will weaken the dollar, and that dollar weakness will result in euro-US dollar strength, and that can also potentially lift the euro pound higher. So it's not without risks, this outlook, but at the moment we would still favour sellers, and any return back up to that 0.9135 region can be considered suitable for shorting. This is an intraday outlook. And the other risks is that we have the ECB Watchers Convention taking place now. There's a lot of ECB speakers. There's a lot of ECB action going on. Expect further comments on the strength of the euro and European inflation. That's really what's triggering the euro downside at the moment, as well as pessimism or difficulties concerning European Recovery Fund and more barriers to a deal. So that's the first thing to be very aware of for today. Euro pound. The other option is obviously euro US dollar sellers from back up at that 1.1730 zone, but obviously looking at the dollar carefully. If we keep seeing dollar weakness and if we see equity weakness, that's going to absolutely boost the euro US dollar higher. So definitely one to be watching going forward. Now, in terms of risk events coming up, we have quite a few. Oh, hello, excuse me. Excuse me. Now, the risk event that we have coming up for the rest of this session, the main one is the weekly crude data points that are coming up here. Now, GDP final, that wasn't expected to move markets. That is as is expected. The key one to look at is this weekly crude stocks for oil traders. Now, there's expected to be a build of 1.569 million barrels. In other words, it's expected to be 1.569 million extra barrels in the market. Now, when there's extra barrels in the market, that weakens the oil price. Okay, so a build weakens the oil price, a draw strengthens the oil price. Now, this weekly data point is preceded by a private inventory data point that comes out the night before. So let's see if here it is. This is the private data. It comes out 9:30 on a Tuesday evening. Now, this private data point has about 80% of the official. Now, the private data, I have the data here in front of me. It's not on this Zenith new calendar, but the private data showed a draw of 831,000 barrels, whereas it was expected to be a build of 1.9 million barrels. So essentially what happened is there's a draw. Now, if you take a look at oil markets, what you can see is that oil markets have been broadly pressured over the last few sessions. There's a couple of reasons for oil market being pressured. One, Libya has returned its supply levels. So Libyan supply level is coming back online. That's negative for oil. Earlier in this month, the IEA and the OECD both reduced their projections for oil demand into this year, and there was also a reduction by the IEA into next year. So in other words, these big oil organizations both think that the world will be using less oil because of rising COVID-19 cases. There'll be more shutdowns. Now, we are seeing rising cases in Spain, France, Germany, in the UK, and with less people traveling, less people working, businesses not at their normal capacities, all of this results in potential more downside for oil. So the bias is to the downside for oil. The crude data will be out at 3:30. very important data. And if we see a build, so what we're looking at is if we see a build in the official headlines. So for instance, if we see, like, say you see anything above 2.7 million, then we expect to see immediate downside in oil. Okay, it's definitely one to be looking out for, and that ties in with more downside in oil. Okay, because there's rising COVID cases. So anything above 2.7 billion, if you see a build of 2.7 billion, expect that to result in heavy oil selling. One to be looking out for later on in the day for sure. The other key market events that we have coming up, just having a look. PMI data will be important for the Eurozone, and Germany PMI data important tomorrow. If we get those if they start missing, if those PMI data starts missing, that will be negative for the euro again. Look at that carefully. We do have some important data for initial jobless claims in the US. Market wants to keep seeing those initial jobless claims falling. Anything below 750,000 is positive for risk. Continuous jobless claims, market wants to see that keep falling. Anything below 11.8 million is positive for risk. ISM manufacturing will be very important data tomorrow. That is the manufacturing in the US. Market wants to see that staying high. If that starts dropping, that's going to be negative for risk as well. So key data points out tomorrow, then heading into non-farm payroll on the weekend, which will be very important because the market wants to see the labor market doing well in the US. If that starts dropping, that again will be very negative for risk. So we've got some key US events. The other key risk events are the televised US election debates. We've got Biden and Trump speaking. Now, yesterday there was some chatter about Biden and Trump and whether that would impact the US dollar strongly. The first round of the televised debate has had very little impact on the dollar. So, but just to bear in mind, that is a risk that's out there at the moment. Another market to look at is, well, I'll show you one swing trade that I'm in. This Australian New Zealand dollar. This is a swing trade that I'm remaining in. Now, I entered this Aussie New Zealand dollar currency pair. I'm just going to refresh these charts, check that this refreshes okay. I want to overlay a yield, bond yield on it. It wasn't working earlier, so I'm hope it's working now, but I'll show you a little trick. Like, I entered this Australian New Zealand dollar currency pair. I entered it earlier in the month, around the start of the month. I bought in around these levels here, about 108.80-ish. And the reason for it was that I expected the RBA and the RBNZ to have a diverging outlook. So I was expecting the Bank of Australia to keep rates flat and the Bank of New Zealand to turn rates negative. So I was expecting Australian New Zealand dollar upside. So I saw some initial upside, and then I was underwater here, running my stop below the 1.0500 region and looking for a push higher up into that 1.100 level. So this trade is now at a discount. So just to be aware that, as long as there's a divergence between the RBA and the RBNZ, that should favor more upside in this pair. Now, I'll show you one of the key tools that I used just to help me in this. It's still not working. Oh dear. Okay, well, the red line, I like it when it overlays on the Australian New Zealand dollar chart and you see the correlation more carefully. This is the bond yield spread between Australian and New Zealand dollar bonds. So this is basically a risk profile that shows, which country is essentially less risky at any given time. So as this rises, the Aussie New Zealand dollar rises. As this falls, the Aussie New Zealand dollar pair falls, etc., etc. And as this rises, the Aussie New Zealand dollar pair rises, etc., etc. So with the yields remaining high, even when the Aussie New Zealand dollar pair dropped, that's what gave me the conviction to hold on. So as long as this yield spread is pushing to the upside, and that gave me the conviction to hold into the trade. So you can see now we're testing that very, very key trend line here on the daily chart. So if you just zoom down to the 4-hour chart, you'll see that this is an absolutely critical trend line that we're testing. If we break above that trend line, expect more upside. If we stay below that trend line, then the jury is still out. But that trend line is going to be a key area. But that, as I said, that's a trade I'm still in. And I'm underwater because I entered around this 108.80. Yeah, around this 108.80 level. So I'm still underwater in this trade, but looking for a move higher, back up to that 1.100 level. So I'm still sort of looking at that going forward. Okay, guys, that's the main issues. Yeah, Schwa, US dollar CAD formed ascending triangle pattern on the US dollar CAD. Yeah, great. Let's look at this. Now, this is a very interesting trade. Yeah. Yes, there is a nice little pattern there. I see it, Schwa. So we have an ascending triangle pattern there. So I like this, Schwa. The reason I like this is we've got US dollar strength on the recent risk flows. So as we've been seeing equity markets falling, we've been seeing the US dollar rising. So over the last few days and weeks, we've been seeing some US dollar strength. So you can see this recent US dollar strength. We are expecting a bearish outlook on the Canadian dollar with oil being pressured. Oil is negative correlated with the US dollar CAD. So as oil drops, US dollar CAD rises. So what will be the catalyst for this trial? It'll be interesting. Is the oil inventory data that's coming out. So with the oil inventory data coming out in just, an hour and a half, if we get a build, Schwa, say above 2.7 million, then for me, that would be an enter at market, because you'd expect that pattern to break to the upside. This is an ascending triangle pattern. Technically, as long as the fundamentals remain good, that's a great trade. You'd look for the height of the pattern. So you'd look for 1.3280 up to 1.3420. So about 140 points. So your technical target would be 1.3420. So about 1.3600 would be your technical target. So quite a good potential risk reward there. Well spotted, Schwa. That's a nice little potential pattern forming. And some traders could consider entering early, okay? Or even if there's a breakdown to here, this would still potentially be a good place to enter long, back down to that 1.3350 region. But I like that. Yeah, Schwa, the APR came in slightly positive, but we haven't had the official oil report yet, and they're expecting a 1.56 million build. So what you have to look at, Schwa, is now look at the official one. If this one comes in with a big build of 2.7 million, that's very, very negative for oil. That's positive for US dollar CAD. If it comes in as a draw, then there's no trade. So if you get a draw, any negative draw at all, then that's sending conflicting signals. you could potentially wait for another, a trigger for that trade. Yeah, the API data came in at a draw of 831,000 barrels, and it was expecting a build of 1.9 million. So you can see the build is still expected. So that does keep some pressure on the oil markets because they're still expecting a build. We'll have to see what happens later. But yeah, that's a great spot, Shwa. Very nice. Nice technical, nice fundamentals. That's how I like to trade, pairing up the technicals and the fundamentals nicely together. Excellent. Really good stuff, Shwa. Okay. Yeah, you're very welcome, Shwa. Those patterns are very effective. They've been used for years and years. Head and shoulders patterns, double tops, double bottoms, trend line breaks. They're excellent. They're very, very helpful. Okay. Tribuvan, view on pound Australian dollar. Let's have a look. You love this pair, Tribuvan. You always ask about this pair. This is your favorite pair. Right, let's have a look. Is it your favorite pair? I don't know. It's certainly, you've got a lot of love for it. Okay, so at the moment, the pound is strengthening at the moment, Trib, on anticipation of a Brexit deal being signed. The Australian dollar at the moment is kind of quite mixed. It's being pushed and pulled around with a risk tone. So we have been seeing some weakness in the Australian dollar as we've been seeing equity markets fall. So as equity markets have been falling, that also pulls down the Australian dollar. So when you overlay the Australian US dollar and the S&P 500, you see that as the S&P 500 falls, the Australian dollar falls. So that's why we've been seeing some medium-term upside in the pound Aussie dollar. Now, the big concern here is, will the Brexit deal actually get done? At the moment, we just have optimism. Now, optimism doesn't necessarily correspond into action. So the key areas to be looking for on the pound Australian dollar is this trend line here, okay? So you can see there's a little trend line on this 4-hour chart. If you just go up to the hourly, the daily, you'll be able to see this, okay? Now, technically, stay above this trend line and the bulls are in charge. Get above this trend line and the bulls are really in charge. So what you're looking at here is, at the moment, I wouldn't have a conviction on this pair because that Brexit optimism, it's there, but it can be one headline it can go. So the risks of this trade is that all of a sudden there's a negative Brexit headline that comes in and the pound sinks. And if you look at the technical mood of the pound Australian dollar, it's been selling. So investors want to sell the pound against the Australian dollar. So that's something to be carefully looking out for. Technically, these are the levels you want to look for. Okay, break above this level, this 1.828 level, and the bulls are back in charge. Break below this level, then the bears are back in charge. And at the moment, we're just having that battle for the reasons that I've mentioned. Yeah, good. Good. I'm glad. Hope that helps, Trib. Good, excellent. They're key levels for you to look at. Okay, I'll just help you as you part your way. What you want, Tribuvan, you want to find a reason, like with pound strength and Aussie weakness, or pound weakness and Aussie strength. So if you get a Brexit deal, if a Brexit deal gets arranged, then it's buying the pound Australian dollar makes sense at the moment. Yeah, but you need to wait for some kind of deal. Yeah, I know you got it. You've been following this for ages. Good, excellent. Well, thank you all very much. It's been great to be with you again. I am scheduled to be back here on Monday next week. Please do join me again. We'll be looking at the latest developments, and also on Wednesday when we'll look at another key trading partner. We'll have another look at some of the key FX relationships and trading partners, just like we did with the Australian just like we did with Australia at the start of the session. So don't forget that key relationship to Australia and China. What's good for China is good for the Aussie, or what's good for the Aussie dollar is probably also good for China. Okay, folks, thank you all very much. Take care and have a very good afternoon. Thank you now. Goodbye.